Everyone's naturally panicking about tariffs, but while they're glued to the headlines, I'm following the money because right now the S&P 500 is flashing a signal that could define the next bull run, and almost no one is talking about it. Go on social media, everyone's talking about tariffs. I'm not, because here's the truth. If you're focused on the headlines, you're already behind. The media is built to trigger emotions, but the market runs on structure, on trends. And right now, the S&P 500, the single most powerful indicator we have, is quietly showing us where the money is going next. And it's not reacting to tariffs, it's positioning for profit. I'm going to show you exactly how to use the S&P 500 to cut through the noise and build a portfolio that thrives in chaos, because successful investors do not follow headlines. They follow the market. Back in 2018, during Trump's first stint in office, when tariffs first hit the headlines, the reaction was predictable. Panic, sell-offs, emotional decisions. I saw it unfold in real time, not just in the market, but in the behavior of investors. But I didn't panic. I'd seen this kind of thing before, and I knew that while the headlines were loud, the charts were quiet and actually far more honest. While everyone else was watching the news, I was focused on price structure. And what I saw in the S&P 500 back then gave me a level of confidence that no headline ever could, because price leads the narrative every single time. And the S&P 500, it was already telling me which way money was flowing. Now, in this video, I'm going to show you exactly what I saw and how I used the chart in 2018 to ignore the noise, identify the companies leading the next trend, and how we can use that same approach right now. I'll switch to the charts to show you how the markets have performed over the past 13 years, continuing to deliver solid profits, especially with the current trade war taking shape. Okay, so welcome to my 3-screen setup here. This is the same setup that I use to analyze every single asset that makes it onto my watch list or into my portfolio. So let's break down what we're looking at. In the top left, I've got the monthly time frame. In the top right, I've got the weekly time frame, and then down here across the bottom, I've got the daily time frame. Notice that I'm looking at the higher time frames, monthly, weekly, daily. There are no intraday time frames. I'm not going down lower than the daily time frame, no 1 hour or 5-minute time frame. I'm a trend follower. So as a trend follower, I'm looking for the big moves in the market, and that requires the right time frames to do that. The chart that we're looking at is that naturally of the S&P 500. We'll start with the monthly. That's where I always like to start because that's the DNA of the asset. It gives us a very clear picture of how it's performed in the past, what it's doing right now, and potentially what could happen going forward. And then we'll go down to the weekly and the daily to look for further confirmation of what price action is doing. So let's start with the monthly time frame. Now, first of all, the S&P 500, as we know, over many, many decades, it's headed up in that direction. It's absorbed 2 massive bear markets in that trend as well. So if we go back in time, this is the 2000 to 2002 bear market. That's when the tech bubble burst. We had the recovery, and then we had the second bear market of recent times, which is from 2007 to 2009. That's what during the financial meltdown. Now, since that low of 2009, that's when it's been very, very interesting for us as investors. The S&P 500 has been on this massive bull run where it's climbed over 700% to its current all-time high. And during that period, it's had numerous corrections, particularly that one around the coronavirus back in 2020. But what we're going to be focusing on is specifically how it reacted during the previous trade war around 2018 when Trump first came into power. And to do that, we're going to go down to the weekly time frame in a second. But one of the key factors that I want to pinpoint for you is these 2 markers right here. You've got this green line and you've got this red line. This green line is the highest point of last year, and this red line is the lowest point of last year. Now, why is this so important? Well, it's important because it gives us a bias to price action. Now, online, we hear the word crash all the time. We've heard this a lot over the last couple of weeks where all of this talk around tariffs is going on. But what we want as investors is to be able to identify what a crash actually is. We want to be able to have clear levels where we are entering potential bearish territory. So how do we do that? Very straightforward. If it's trading above the highest point of last year, we have a bullish bias. That's when the stock market or the S&P 500 has a bullish bias and it's looking to push up. If it's trading below the red line, which is the lowest point of last year, then the market has a bearish bias. That is when we start entering bearish territory where the stock market could potentially be crashing and we could actually start looking for shorting opportunities. Now, remember, just because the stock market is going from bullish to bearish doesn't mean all it's lost. We can actually short the market and make profit as the market declines. That's one of the advantages we have with online brokers today. But here's the thing, during this whole correction in the market or this crash that everyone is talking about online, it's remained between the high and the low of last year. So for us, that is actually telling us that it's actually in a correction phase. It isn't actually crashing at all. So you can see how useful it is to have these two very simple markers on the screen, the high and the low of last year on the monthly time frame. And as long as the index or any asset that you're looking at remains between these levels, then we're very likely in a correction rather than an actual crash. So now that we've looked at the monthly, let's move across to the weekly time frame, because the weekly time frame is very, very useful when it comes to narrowing down on actually what the trend is actually doing. Now, if you look at this current correction that we've just looked at, not only is it between the high and the low of last year on the monthly time frame, it's still actually trading above this black line. Now, this black line is the 200 simple moving average. Now, why is this moving average, this black line, so important? Old school traders used to draw charts by hand, so they were very particular with the information that they put on their chart. What they discovered was that the 200 simple moving average was a proven indicator of the long-term trend. So if the asset was trading above the 200 simple moving average, the overall bias is bullish. So they'd always be looking for long opportunities. Now, there may be an element of patience during corrections, but ultimately, as long as it remained above the 200 simple moving average, the bias was bullish and they'd look for long opportunities. When the asset broke below the 200 simple moving average, that's when the bias switched from bullish to bearish and they'd look for shorting opportunities. So again, you can see how clearly we can define when a market changes from bullish to bearish, where we actually enter this crash territory where the market could potentially decline further. So why is the 200 simple moving average so relevant? Well, to understand that, let's go back further in history. And I'm actually going to go back to those two market crashes that we identified earlier. Here is the market crash from 2000 to 2002. Now, why was it a market crash? Because it actually broke below the 200 simple moving average. And if we go to the market crash from 2007 to 2009, in 2008, it actually moved below the 200 simple moving average. So you can see very clearly why these were actual bear markets. Now, the market, the S&P 500, it found support in February of 2009. That's when the recovery came back in, broke through the 200 simple moving average in 2010. Now, here's why we need to keep a very close eye on the 200 simple moving average on the weekly time frame. Since the move back above the 200 simple moving average in 2010, we can see how it's used the 200 simple moving average as a trampoline. Strategically, it's come back, touched it, and then bounced further up. So it did that in 2011. We had this climb to the upside. We then had another correction to 2016 where it found support, had a significant move to the upside. We then had this correction in 2018. Now we're going to come back to 2018 in a second, because that's where the previous trade war came in when Trump first came into power. We're going to look at that in a second, but let's just focus on the 200 simple moving average just a little bit longer. 2018 bounced off the 200 simple moving average. Now this correction right here, this is coronavirus, and it's a black swan event. During black swan events, there's often a lot of aggression, a lot of violence, a lot of big swings, but then it quickly recovers, the market quickly recovers and continues on this bull run. This is precisely what we saw during coronavirus. We had this 35% decline at the start of 2020, broke below the 200 simple moving average temporarily, and then quickly whipsawed back above it and went on this massive bull run. That was the all-time high of 2021, 2022, and we had that natural correction back to the 200 simple moving average. Again, came to the 200 simple moving average and then went on this significant 70-75% bull run it's been in since that low of 2022 to the current all-time high of January, February this year, 2025. Now, if we look at this current correction, it's still above the 200 simple moving average. It's also trading around that 5,000 round number, a major support level. So we have a strong support zone here, the 5,000 round number and the weekly 200 simple moving average. So again, without even looking at the fundamentals, regardless of what's happening in our media channels, what's happening online, ultimately, as long as the index remains above the 200 simple moving average and uses as this sort of trampoline where it comes to and then bounces off it, our overall bias remains bullish, and we are not in this so-called market crash that everyone online seems to be talking about. Now, if it breaks below the 200 simple moving average, of course, that's when things get interesting and we could potentially start seeing further weakness. But as long as it remains above that black line, we are overall in a bullish bias. Okay, so let's go back to 2018 and focus on that first trade war that kicked off between America and China when Donald Trump first came into power. So this is this period around here. And it was during this initial decline back at the start of 2018 when we saw this decline rather in the market. Now, what happened back then? Well, ultimately tariffs were imposed on hundreds of billions worth of Chinese goods. China retaliated, market volatility spiked. So this was that initial sort of decline. Then there was a recovery in the market, a sort of very natural recovery with it bouncing off the 50 simple moving average, and then volatility spiked again towards the end of 2018. Now, here's the thing. Where did it come to? It came to the weekly 200 simple moving average. So if you had turned off your media channels, again, had no idea there was a trade war going on back in 2018, as investors, all we really needed to do is get an idea of how far the index, the S&P 500, could decline. And what it did was came back to the 200 simple moving average, bounced off it, and we then went on this significant climb from that low of 2018, which was around 2,350, and then it spiked at 3,400. And then the coronavirus correction came in. So you can see, looking at that 2018 pattern of it coming to the 200 simple moving average, it's that same pattern that we have seen unfold today with the S&P 500 declining and coming close to, but remaining above the 200 simple moving average on the weekly time frame. Okay, so now that we've looked at the weekly, let's have a look at what's happened on the daily time frame. Now, on the daily time frame, it paints a slightly different picture. And this again is why a lot of people are panicking. Ultimately, this talk around tariffs has caused the S&P 500 to decline below the daily 200 simple moving average. We can see how it found support around the 5,000 round number, and that's where the move to the upside has come in. But ultimately, what we're waiting for now is further momentum to the upside. If we see a move back above the 200 simple moving average on the index, then what we have is alignment between the weekly and the daily time frame. Both are trading above the 200 simple moving average, and we are now back in bullish territory. Okay, so just a quick summary of what we've just gone through. On the monthly, look at it in relation to the high and the low of last year. Currently, the S&P is inside these levels. In a second, I'm going to show you some stocks that paint a slightly different picture and how these stocks are actually leading the recovery. On the weekly, look at it in relation to the 200 simple moving average. As long as it remains above the 200 simple moving average on the weekly, we are not in a market crash. We're simply in a correction. And if we come down to the daily time frame, well, at the moment it's below the 200 SMA. It's finding support around that 5,000 round number. All we're waiting for now is to see the S&P 500 move back above the 200 simple moving average to confirm that we have recovered and we're now entering that next bullish phase. So a little bit of patience needed for now. However, at the very beginning, I mentioned that I'll be sharing some stocks that are actually leading the recovery, that are at the top of our watch list, and that are setting up for what could potentially be a very lucrative 12 months ahead. So let's have a quick look at those stocks. The first stock, Berkshire Hathaway. Now, there's been a lot of talk about Warren Buffett stockpiling cash. However, his stock is painting a very, very different picture. And if you focus on his stock rather than what he's doing with his own cash, you as an investor would be making a lot more money. So let's start with the monthly time frame. First of all, Berkshire Hathaway overall has a very good performance history, moving up and up and up and up over decades. These are the kind of stocks that you want to look at. Proven performance history. But look at what it's doing right now. It's trading above the high of last year. Remember, the S&P is below this level. Berkshire Hathaway is above this level. So it has a bullish bias. It's leading the S&P 500. If we come down to the weekly time frame, it's above the 200 SMA, which is the black line. It's above the 50 SMA. And our proprietary trend filter is green. You'll notice that we don't have, if I just open up the weekly, we don't have the standard red and green candlesticks as you would see on a normal chart. What we have is a trend filter, which gives us periods of bullishness where the trend filter is green, gray where it's moving sideways or pulling back, or red when we're entering bearish territory. Notice how during the S&P 500's correction, our trend filter has remained green and gray all the way through. A little bit of red here, but we can ignore that. Has remained above the 50 SMA and above the 200 SMA. It shows how strong this stock is during a market correction. Also, how close it is to its all-time highs. And if we come down to the daily time frame, what we can see on the daily time frame, if I just open that up, is that there was a decline. Look where it came to, the 200 simple moving average. The S&P 500 broke below its daily 200 simple moving average. Berkshire Hathaway found support at its 200 simple moving average, has bounced, and it's now trading very close to its all-time highs. The next breakout, our trend filter will turn green, and we are then in bullish territory. So you should be able to see why Berkshire Hathaway is a stock at the top of our list. The next stock we will look at is Brown & Brown. Likely a stock you may not have heard of, but look at its performance history on the monthly time frame. Solid performance history over decades. So you can see how this has rewarded its investors very, very handsomely. Again, it's above the highest point of last year, so it has a bullish bias and it's leading the index. On the weekly, it's above the 200 SMA, it's above the 50 SMA, and look at the trend filter. It has remained green and gray all the way through the correction, telling us that the bigger time frame is very much bullish. And if you come down to the daily time frame, here is the recent correction, remained above the 200 SMA. It's now moved back above the 50 SMA, and it's working its way back to its all-time high. If it moves through its all-time high, that will be a sign or the signal that we're looking for it to be moved into our portfolio. It's on our watch list. We'll take positions. Okay, next one. Again, a stock you may be unfamiliar with, Cencora, ticker symbol COR. Let's open up the monthly time frame. Solid performance history again over many, many years. Again, it's trading above the highest point of last year, and it's moving to the upside, showing how good this stock is and how resilient it is even during a correction. On the weekly, it's above the 200 SMA. Let me just open that up so you get a clear picture. It's above the 200 SMA, and you can see the trend filter is green, really starting to gather momentum. And if we come down to the daily time frame, the correction hasn't come anywhere near the 200 or the 50 simple moving averages. It just created a small pullback, created a nice little base, and we're waiting for the next breakout. Our trend filter to remain green. You can see it's currently green, and a continuation to the upside. So again, Cencora, a very good stock to have on your watch list. Next one, Rollins. Let's open up the monthly time frame. Again, solid performance history, steadily moving to the upside over many years, trading above the highest point of last year. You can see this bullish trend that is coming into play. If we come down to the weekly time frame, above the 200 SMA, above the 50 SMA, and the trend filter is green, telling us that we have a trend in play. And if we come down to the daily time frame, I'm just going to open that up so you get a clear picture. It's above the 200 SMA, above the 50 SMA. The trend filter has turned from red, where it found support, at the 200 SMA to gray, and it's now green with this bullish momentum kicking in. So the next move above the all-time high, the next breakout, that will be a strong sign of a continuation to the upside. The next stock we will look at is one that you should be familiar with, which is Visa, starting with the monthly time frame. Now, if we look at Visa in terms of its historical performance, it's a very, very, very attractive chart. If all stocks look like this, if all stocks we found look like this, we would be very, very happy. These are the kind of stocks you want. Beautiful performance history. And if you look at what it's doing right now, it's trading above the highest point of last year, and it's working its way back to the upside. If we go to the weekly, it's above the 200 SMA. Look at the correction. It came to the 50 SMA and has bounced off it. The trend filter is still gray. We want to see it turn from gray to green, but it never turned red during this correction, showing again how resilient this stock has been during the correction. Now, if we come down to the daily time frame, it has come to the 200 SMA. It bounced off it. It's worked its way back to the upside. The trend filters turned gray. What are we waiting for? Same as all the other stocks. We want to see further momentum to the upside. The trend filter turned green, a breakout and new all-time highs. And that's when we can start considering positions for the portfolio. Okay, so the S&P 500 isn't reacting. It's revealing. And understanding that structure, that's the difference between chasing noise and positioning yourself early. But here's the thing. Spotting structure is only half the game. What you do after that, how you build your watch list, how you time your entries, and how you reset each week, that's what turns signals into real, consistent returns. In fact, our entire community follows a simple weekly routine that's been responsible for over 30% plus average annual returns, and is probably the most overlooked part of the process. So if you're serious about applying what we just covered, this next video breaks down that routine step by step. Click on it to watch it right now, because structure gives you confidence, but routine, that gives you results.